advising clients across the country. Here he is, your host, J. Christopher Boyd.
Talking with Rick Edelman of fame as a radio show host, author, and successful and registered investment advisor. One of the things that we want to talk about in this, digital assets, cryptocurrency. Is the question: is it right for everybody? You mentioned that everybody's trying to create wealth or maintain wealth. Right now, it does seem that when it comes to digital assets, we kind of interchangeably referring to cryptocurrency. I never know what to call it these days. When it comes to Bitcoin or Ethereum, there's all these choices, and there's kind of uniformly, there's been a lot of volatility. Some of it's fabulously good. Some of it's been not so good, right? And it's been back and forth. You've been in it a long time, but people who've gotten interested in this, many of whom have only gotten into it in the last few years. And of course, that's a very different experience. So talk about that issue about the volatility of this as an asset. We think of currency as a store of value in a sense, like something that when I pay for something with currency, it's going to be worth what I expect it to be worth. And this is an ever-changing dynamic. That may be a different topic, but ultimately, who's it for that would be appropriate as an investor, do you think? And then subsequently, maybe this idea of talk about that, the valuation issues.
Sure. You've asked a lot in there, Chris.
Yeah, I'm sorry. Throw it all at you.
But understandable, because there's a lot there. And we could have removed the word crypto in everything you just said and inserted the word stocks, because that's a big conversation too.
Right.
So you're asking all the right questions. First, is it right for everybody? Nothing is right for everybody, except maybe oxygen. And so that's your job as an advisor, is to figure out which of my clients is this right for?
Yeah.
And for those it's right for, how much of the portfolio should I put into it? And how do I do it? So those are really the key questions. So let me try to break it out for you as simply as I can, as concisely. As I said, it is a big conversation, but we can boil it down to a few basic fundamental issues. First, there are two conversations, and you touched on them. There's cryptocurrency, and there's crypto assets. So we need to break them out. When Bitcoin was invented in 2009, the goal of Satoshi Nakamoto, the inventor, the goal was for Bitcoin to be a currency. And Satoshi's goal was for Bitcoin to be the currency, replacing all government currencies all around the world. That experiment failed. Bitcoin is not a currency. It's never going to be, for the reason you cited. It's volatile. And if there's one thing we need from a currency, it's stability of price. I need to know that a dollar is a dollar is a dollar. A yen is a yen is a yen.
Yeah, fill in the blank. Yeah.
And Bitcoin
and to that point, when I think about my clients' investments, although, institutions may do this, I don't generally talk to my clients about investing in yen or yuan or, some other currency, as an asset class. I generally don't talk that way. We might invest in assets that are held in other currencies, perhaps, though.
Well, you do recommend
international.
No. You recommend currencies to your clients all the time. They are always dollar denominated, and you call them cash.
Yeah.
You recommend cash reserves for your clients as a routine part of your
yes, but that's the dollar.
That's the dollar. Well, there are digital assets that are equivalent to the dollar. They are called stable coins. These digital assets have a one-to-one correlation to the US dollar. The USDC, US digital coin, or Tether, these are digital assets that people use as an alternative to holding dollars. They are the same. It's the same thing as having your money in a money market account or a bank CD instead of dollars, because dollars earn no interest. Dollars can be lost. Dollars can be stolen, if the money's in your pocket. So we put our dollars in a bank account, but they're still dollar equivalents.
Yeah.
And stable coins do the same thing, but you're not going to turn to them for investment purposes for the same reason you don't turn to a money market fund for investment purposes.
Can I challenge you on that before we move on?
Sure.
In the case of stablecoin, have there not been examples of stable coins that have failed when it comes to, cryptocurrency stablecoin?
The only stable coins that have failed are stable coins that were not pegged to the dollar. And that's one of the key due diligence questions you need to ask if you're going to consider a stable coin. When I buy this stable coin, when I take my dollar and turn it into a dollar coin, is that dollar coin backed by a US dollar or a US Treasury? In the case of Terra Luna, which blew up last year, they were not backed by dollars. They were backed by an algorithm. It was a dumb idea. When it blew up, people said to me, Rick, are you surprised? And I said, I'm surprised it took this long to blow up.
So it's a question for the consumer to understand what they are using in this space.
It's the same thing you would say to a client who wants to put money in a bank account. The first thing you would say is, make sure it's FDIC insured.
Right?
Same thing with a stable coin. Make sure it's a 1-to-1 reserves of US dollars. So you begin with that premise, but that's a distraction. Nobody's going to get rich buying stable coins because nobody's going to get rich having money in a bank savings account or money under a mattress. So set that conversation to the side. Let's focus on the real issue that you've asked about, which is digital assets. Assets are not currencies. Assets fluctuate in value. The goal, the hope, the theory is that they will fluctuate more up than down. But that's what, as you noted, that's what volatility is all about. I love it hysterically when people tell me they hate volatility. They're liars. They hate downside volatility. Absolutely. I've never seen anybody complain about upside volatility.
Absolutely.
So we need to recognize, therefore, that Bitcoin has a lot of volatility, more than any other asset class to date, or so it may seem. You want to have a lot of fun? Do this when you get a free minute. Go online and Google Bitcoin's price history from inception to date. And very easily on the internet, you'll punch up a chart showing its price volatility, and it will prove for you everything you know. Wow, is that volatile? But then do this. Search for Amazon's price history. And you put those two charts side by side, they're damn near identical. In other words, in the early days of the internet, when Amazon was first getting started in the 1990s and 2000s, it was just as wildly volatile. That's the nature of any new innovative technology. Nobody knows if it's going to work. Is it going to pan out? There'll be market adoption? Will a new competitor come in and wipe it out? And you get astonishing levels of volatility. So you have a choice as an advisor or as an investor. You can invest in something that is new, that is emerging, that is under development with a lot of unknowns. And if you do invest, if it succeeds, you will receive outsized rewards. That's the risk premium that is all about asset volatility. Or you can wait until it proves itself, until it is established, where it becomes obvious that this is a key investment opportunity. In other words, there are a lot of people, I shouldn't say a lot, there were some people who bought Amazon in the 90s and kept it. Today, everybody owns Amazon. If you own any stock ETFs, Amazon's in the portfolio. Same thing with Bitcoin. You can buy it now, hope it works out, or you can wait. If you wait, you simply won't enjoy the incredible price appreciation that people are expecting.
To that point, when I started using the internet, I used America Online. My relatives used Prodigy. These are not typically the way we'd benefit from being early adopters, early investors in internet today. Talk about some of these different coins for a minute. Bitcoin, Ethereum seem like the prominent names we hear about the most. And there are some differences between the way, these two different, the way they operate and others operate on them and so forth. But Talk a little bit about that, and how do we get a sense of who'll be the winner,
Right.
so to speak?
Yeah. So let me just,
and what's to say there won't be lots more?
yeah, let me answer that. That's a really important question. Let me preface it by saying this. You don't have to decide if you like crypto or not. If you believe in portfolio diversification, and if you believe in long-term investing and rebalancing, then you are arguing that you should have crypto in the client's portfolio. If you believe in modern portfolio theory and the efficient frontier, you probably already have in your client's diversified portfolio assets you don't like. That's the nature of a diversified portfolio. 15 or 20 major asset classes and market sectors. We're going to invest in large cap, mid cap, small cap, US and foreign. We're going to have commodities. We're going to do emerging markets. We're going to have oil and gas. We're going to have everything under the sun, because that's what diversification is all about. And where we're wrong, rebalancing helps adjust it. We're going to dollar cost average, and we're going to do X loss harvesting. We're going to do all the stuff that we've learned how to do, because that's the right way to run money. And that means we want to add as many asset classes as we can to further improve the efficient frontier and the Sharpe ratio and standard deviation and max drawdown. That's how we run money. It's Sortino ratio, all of that data that we've come to learn through our careers. That's why you should add crypto. Has nothing to do with whether you like it, has nothing to do with whether you think the thesis makes any sense. It has nothing to do if it's going to work. What I do caution, however, is that if you are going to add crypto to the portfolio, because it is so risky, meaning we don't know if it will work technologically, we don't know if there will be long-term mass consumer adoption, we don't know what the regulatory landscape is going to be, limit the exposure. My recommendation, which I talk about in my book, The Truth About Crypto, is 1% of the allocation of the portfolio. That's it. And that surprises people sometimes, Chris, because they like, Rick, if you're such a Bitcoin optimist, why only 1%? Two reasons. First, if I'm wrong and this blows up badly, that 1% allocation will not harm the client. They'll still be able to achieve financial security. But if I'm right and it works, and we get a 5 or 10 or 20x return, that 1% allocation is enough to materially improve the client's outcome. So it's a wonderful risk-reward ratio. That's why I say only 1%.
Yeah, that's pretty compelling, I think. To say the 1% is pretty compelling to make that case. Yeah. It's not enough to be terribly damaging. On the other hand, if it does, that resonates. I get that.
Let me answer the question you asked of Bitcoin versus Ethereum versus the 20,000 other coins. So if we're in agreement, yes, for clients or for most of them, and only a 1% allocation. The next question is how? What do you buy?
I'm not sure I'm there yet, but okay. Let's say we are.
Work with me here, people.
Yeah.
So let's talk about Bitcoin. This is the original digital asset. It is not a currency, as we've discussed. It has failed in that effort because of its volatility. What people regard Bitcoin as is a store of value, which is what any asset is. Stocks, bonds, real estate, gold, oil, they are stores of value. The question is, how good a store are they relative to holding their value and growing? Yep. But that's essentially what Bitcoin is. It has some utility in commerce, but not much. The best use of it in commerce is as a payment technology. I can send you my Bitcoin and I can do it almost instantly and virtually free. That is a big deal if you are planning to send money to somebody in another country, what's called a cross-border payment. This is a $4 trillion industry. And if you want to send money to somebody in another country, corporations do this every day, and so do immigrants, sending money back home to mama, because I went to a new country with economic opportunity. It takes, under the global financial system, the SWIFT system, or Western Union, it takes on average 5 days at a commission cost of 6.5% to send money from one country to another. You can fly money to London faster than you can wire it there. Bitcoin solves that problem. It sends the money in 10 minutes for free. That's a pretty good use case, but that's about the only real use case. This is why Ethereum was invented. Ethereum recognizes that Bitcoin is cumbersome. It's relatively slow. It only does 7 transactions per second compared to Visa, which does thousands per second. So Bitcoin is slow, and Bitcoin is also pretty dumb. If I send you my money, you get it. I might not want you to. I might want you to get my money only if you do something for me, like give me concert tickets or the deed to your house, or you get my money only if Trump wins or loses the election. An if-then arrangement, right? Only if the weather or it rains or whatever. So Ethereum has been built to be something called programmable money or smart contracts, meaning you can program into the coin as software the condition on which the money gets transferred. This makes it usable in industry and commerce on a global scale because every business does contracts. And Ethereum acts kind of like an escrow agent without any humans involved. And this is a huge leap forward in business software. And that's why there's so much excitement about Ethereum. Bitcoin and Ethereum today, as you noted, they're the Coke and Pepsi of crypto. There's Bitcoin and Ethereum, and then there's everything else. The two of them have 60 or 70% of the global market share. And so what I tell people is just buy Bitcoin, just buy Ethereum, or a combination of the two, call it a day. If you want to go deeper into some of the other coins that are doing nifty things, that are solving unique business problems, that are growing in their effort to achieve market attraction, you can go do that if you want. And the best way I have found is a fund called the Bitwise 10 Crypto Index Fund. This is a fund that holds the 10 largest digital assets by market cap. So again, Bitcoin and Ethereum are the top 2, and the other 40% are these 8 other coins. They rebalance it monthly. And that's an alternative way that you can look at this.
Rick,
So,
is that a 40 Act fund?
It is not. There are no, it is not a 40
I didn't
Act
think
fund.
so.
Yeah, so this trades like a closed-end fund, meaning there's a big premium discount feature that you need to be aware of. The fund right now trades for like a 50% discount, which means you're buying, for every $1 you invest, you're getting $2 worth of Bitcoin. Many people consider that a hell of an arbitrage play, but you absolutely need to be aware of that fact. There are crypto ETFs that are 40 Act products, but these crypto ETFs don't buy Bitcoin. They buy stocks of companies that are building the technology. So companies like NVIDIA that manufacture the computer chips that go into it, or IBM, which has a big blockchain business, and Coinbase, which is the biggest US crypto exchange, things like that. They're directionally correct. They generally track the price of Bitcoin and Ethereum, but they aren't Bitcoin and Ethereum. So there are other examples of how you can do this simply and easily with no compliance or regulatory concern, because they're securities. They're ETFs like any other ETF.
My brother is an estate planning attorney, and he's very interested in the whole smart contract concept of how this could ultimately evolve. How assets transact.
I'll give you one simple example. There are now real estate companies that are selling homes on the blockchain, meaning that instead of it taking 90 days for you to buy the house and settle on it, they're doing the transactions in 90 seconds with cryptographic proof of the validity of the deed. And they're bypassing the escrow agent. They're bypassing the title settlement attorney. You don't have to buy title insurance. It's radically speeding it up and radically reducing the costs associated with homeownership. That's just one of thousands of examples of how this technology is changing business globally.
We're talking with Rick Edelman about cryptocurrencies, digital assets. And Rick, one of the things I wanted to come back to, you talked about the idea of diversification, asset allocation, the idea that this makes sense to have some exposure, even if it's a modest exposure. That raises a whole bunch of logistics kind of challenges. You can't hold this in a brokerage account. We just discussed these aren't necessarily available in a mutual fund, a traditional fund where we actually hold these. assets. Maybe talk a little bit about the logistics. If you actually do this in a portfolio and it does grow in value, how do I rebalance? How do I go about that effort?
So the good news is
you may also want to explain wallets and some of that kind of thing, because it gets kind of confusing as it relates to that.
Yeah, it is a complicated conversation, but I'm going to radically simplify it for you with some really good news. Your premise that there's no easy way to add this to your portfolio is no longer true. It has been true for most of the last 12 years, but things have changed. Crypto's growing up because a lot of these crypto companies are hiring Wall Street executives and former regulators, and they're applying a financial service industry overlay to the crypto community, and they are providing the same kind of services and benefits that we're used to getting from ETFs and mutual funds, from brokerage firms and insurance companies and banks. We're now getting those products and services in the crypto world, which is really exciting. For example, Fidelity now allows you to buy Bitcoin directly from Fidelity in their brokerage account with a minimum investment amount of $1. Just yesterday, Fidelity, Schwab, and Citadel announced that they have launched EDX Markets, which is a brokerage exchange platform that is allowing individual investors to buy crypto that they can now apply in their brokerage account. We have a variety of ETFs and over-the-counter securities from Grayscale, Osprey, and Bitwise that are securities that directly own Bitcoin and Ethereum that you can buy in your brokerage account alongside your mutual funds and ETFs. And as a result of this, because these all sit there in those accounts, you can easily rebalance, you can dollar cost average, you can tax loss harvest. In other words, 5 years ago, Chris, an advisor would have had to dramatically alter their practice to include crypto, which is nuts. I would never recommend that. Today, you don't have to. Crypto has now evolved to conform to the advisor. You don't have to change your tech stack. You don't have to retrain your staff. You don't have to reculturalize your clients. You instead simply say to a client, I have found a way to further improve the portfolio diversification. I would like to add this particular investment. It's a security, just like all of your other investments are securities. We can buy it on the platform, just like all of your other assets. And I can do all of my services as usual, including the debiting of your fee. We even now have SMAs from Eaglebrook, for example. You can create a separately managed account of digital assets. You can have a single coin, or you can have a diversified array of coins. Franklin Templeton, for example, has their crypto portfolios on the Eaglebrook SMA platform. We have IRA custodians such as Choice, $21 billion custodian that allows you to buy Bitcoin and Ethereum and dozens of other digital assets inside of an IRA account where you can rebalance it. All of these companies upload to Orion and InvestNet so that you can do all of your portfolio reporting and record keeping and tax reporting, just like you do the rest of the account. You'd be amazed, Chris, how easy it is now to include crypto in your portfolio.
Tell us a little bit about, we've seen in recent months some bad actors when it comes to regulatory engagement of worries about our consumers' funds being handled properly, being commingled. We've seen some problems. So does the fact that a Fidelity or a Schwab is going to be engaged as a platform, a custodian of sorts, does that materially change as opposed to doing a Coinbase? Or, which may be fine. That's not one of the ones that was one of the bad actors. I want to be clear. But
although Coinbase is being sued by the SEC.
Yes, right. That's right. That's right. So, and who was the one that FT?
FTX last year and
FTX.
Binance.
With our quarterback.
Binance, yeah.
So I agree with you. The
So-
crypto community grew up outside of the financial services industry. So most of these crypto companies are startups. If you find one that's more than 4 or 5 years old, that's saying something. And in many cases, you don't know who the principals are. You don't know even where they're located. You have no idea who's on the board. You don't know who their auditor is. You don't know if they're complying with federal laws and regulations. A lot of these outfits are
US based
offshore.
or foreign based.
Yeah,
Yeah.
I mean, FTX was offshore, so's Binance. So that raises a lot of red flags from a due diligence perspective. And I share hesitancy to engage in any of these outfits. What we need to recognize are two things. Number one, the SEC is doing of late a pretty good job at identifying and going after and shutting down these errant players. They shut down FTX last fall, and now they're going after Binance. All of that, I think, is very good. But where I do take issue with the SEC's behavior is that we in the crypto community have been clamoring for regulatory clarity. We don't have a lot of rules on the books because those rules were written back in the 1930s and 40s, well before technology came about and long before crypto emerged. We need some regulatory clarity. And Gary Gensler, the chair of the SEC, has said adamantly, we don't need any more regulations. So it's rather frustrating to us in the community. I'll give you an example. He says, I'm upset that crypto companies are not registering with the SEC.
Yeah, considering them securities.
And that's why he's suing Coinbase. He's accusing Coinbase of being an unregistered exchange selling unregistered securities. Okay, fine. If that's true, then why is it when these companies do go to the SEC with an application to register, the SEC rejects the application? Gary Gensler can't have it both ways. He can't say, we want them to register and then deny their registration. That's simply unfair.
Do you think that the SEC is the proper regulatory authority as compared to a commodities exchange or some other type of exchange overseer?
Most in Congress believe that it should predominantly be the CFTC. There are bills in both the House and the Senate which would provide that clarity, partly because they're very frustrated with how Gensler has been operating the SEC regarding crypto. The SEC is being sued by both Grayscale and Coinbase for its failure to adhere to its own regulations in approving these applications. And so we are expecting to see legislation before too long that will provide this clarity. The law depends on which bill you look at to see how it shakes out. But the good news is that over the next 18 months to 2 years, we are going to have the clarity everybody is seeking. In the meantime, I think your point is the best. Let's focus on the companies that we know are operating correctly, that have a long track record of consumer protection, who have strong reputations that they aren't going to gamble or risk simply because of crypto. So when you look at companies like BlackRock and Fidelity and Schwab and Invesco and Global X, you can get an awful lot of confidence that these folks are going to be safeguarding your investment, that they're going to be operating within the regulatory rules, that although crypto is risky, they're not going to pile the risks on by using an unregistered offshore custodian or engaging in inappropriate behavior. At the end of the day, FTX was a fraud. Sam Bankman-Fried, who ran FTX, had nothing to do with crypto any more than Bernie Madoff was in the stock market. So we need to make sure we're separating the cons from the legitimate companies. And the good news is there are fewer and fewer cons out there because the SEC is doing a good job of cleaning it up. And there are more and more legitimate companies engaged because they all recognize that this is an important asset class that is going to help transform commerce on a global scale. And they are very actively getting in this business. BlackRock just 3 days ago filed an application for a Bitcoin ETF. They wouldn't have done that if they weren't feeling really confident about this. JP Morgan has its own digital coin called the JPM coin. They're doing international trade settlements worth billions of dollars. They wouldn't be doing this if they didn't believe that this technology was powerful and transformative.
I think there are some challenges for advisors thinking about doing this as it relates to the compliance. You just talked about some of the challenges with the regulators dealing with the securities or the coins themselves.
Mhm.
But as an advisor, I look at this and say, is it worth it to entertain like the scrutiny that may come from this? Any thoughts about that?
Yeah, I agree with you. There are two ways to do crypto. One of them I would not touch as an advisor, but the other one's okay. The first one I would not touch, to your point, Chris, I would not tell my client to open a Coinbase account and buy Bitcoin. That is essentially selling away. I wouldn't do that any more than I would tell my client to go to a local coin dealer and buy some coins, or a comic book store and buy comic books. I would not do that. The SEC would frown on that. FINRA would frown on that. I don't see why you'd want to place yourself at regulatory scrutiny for a lousy 1% allocation in the portfolio, where the client is doing this on their own without your engagement, where you can't do your job of rebalancing and monitoring and tax record keeping and so on. No way I would go anywhere near that. But there's another way you can engage that is simple and easy, that poses no regulatory scrutiny of any kind. Your compliance department would love this. They would easily say yes. Simply choose securities that happen to invest in the crypto space. There are crypto ETFs, as we talked about. There are over-the-counter securities. There are SMAs. There are what we call proxy stocks. For example, if you were to buy stock shares of MicroStrategy, this company owns $6 billion worth of Bitcoin. The stock moves pretty much in sync with the price of Bitcoin. Even though MicroStrategy is one of the world's largest business intelligence companies that has revenues and a big business operation, Wall Street treats it like a Bitcoin proxy. It's just a stock. You can own it alongside Delta and IBM and J&J. There's no compliance officer in the country who would object to you adding a stock to your client portfolio, or an ETF that is thematic. You already have retail ETFs, manufacturing ETFs, you have technology ETFs. Here's a crypto ETF.
Maybe if you wouldn't mind talking about this notion of decentralized finance. One of the appeals that seem to attract certain people to this area is the notion of this decentralized finance, DeFi. And I think there's some question about risks related to that in my mind. We recently just had a mini bank scare, and the Federal Reserve, our central bank, and the FDIC stepped in, made some adjustments, and nobody's really worried about running on the bank right now. I feel as though, there's a value. Maybe it's a question of ideological bent or something like that. But I think people are drawn to the idea of, hey, let's get the government out of this mindset. But there is some practical advantages to having a central bank in times of crisis. And is there not, even if you ignore that, and we continue to have the growth of decentralized, crypto and whatever, does that create some spillover effect for volatility concerns, not only in digital assets, but also in stocks, and when people need liquidity or have events that it ends up having a spillover consequence? Couple of thoughts for you to share with there.
Yeah, you're asking, Chris, the big macro question that we have been asking for hundreds of years regarding the function of money in society, the degree to which governments ought to be involved and in control. And we know what the current system is: the use of central banking, which determines the operations of banks all around the nation, and by extension, internationally with our foreign partners. We have been confident over the past several decades that our banks are safe. that our deposits in those banks are safe. That certainly wasn't true prior to the 1930s. Back in the Wild West days, people were reluctant to put money in banks because bank robbers would show up, steal the money, and if your money was stolen from that bank in the West, that money's gone. There was no FDIC to reimburse you. So today it's much safer, or so we thought, until the SVB collapse and the Silvergate collapse, because although your deposit of $100,000 is fine because it's covered by FDIC all the way up to $250,000, that's not true for a business's payroll account. I mean, take a look at your grocery chain, take a look at any retailer, take a look at any business with a couple of hundred or 100,000 employees. They have tens of millions of dollars in their payroll account. Those payroll accounts in the local bank are not covered by FDIC. And so when the government regulator seized those banks, ostensibly because of their crypto risks, all of a sudden there was a huge level of fear that ordinary businesses who were using the banks for their operations and payroll accounts were suddenly going to lose all their money. And that would put all of those businesses out of business. And that forced the government to say, we will cover all deposits. Well, that's wonderful, except that the FDIC doesn't have the money on hand to cover those deposits if there is a true economic crisis, as there was in 1987 or 2008, let alone the crash of 29. So it raises the question of a lot of people, exactly how safe is my bank? And one of the ironies of this is that after the collapse of Silvergate and the government takeovers of it and SVB and First Republic, a lot of people said, I think Bitcoin is safer than my bank because Bitcoin is not associated with government. It is not connected to the US banking system. The government can't seize my Bitcoin. They can't suddenly declare that my Bitcoin account is frozen or no longer exists, as they did with bank accounts at SVB and First Republic and Silvergate. And so Bitcoin's price went up in the aftermath of those bank seizures, as people began to say, I think rather weirdly, that Bitcoin's safer than my bank. I mean, I think it's pretty weird. We know that banks don't have volatility and Bitcoin does. I'm not quite sure how you say Bitcoin's safer than my bank, but that's what a lot of people said. I don't think the government had that as an intended outcome of their activities. And it raises that issue of DeFi, which is where you began your question. To understand DeFi, we have to first talk about CeFi, centralized finance. That's what we operate in this country. If you want to pay a bill, you send a check, or you use a credit card or a debit card or PayPal or Venmo. That means that between you and the person you're paying, there's somebody in the middle. There's an intermediary. That is centralization. If you want to buy a plane ticket, you have to process that transaction through your bank. And that centralized function is what many people regard as the weak link in this chain, that's what makes it all risky. What happens if that centralized feature collapses, is seized, or runs out of money? If nothing else, at the very least, they're going to charge fees. The bank has an incredible level of control. They decide if you get to open an account. They tell you the minimum balance. They tell you what the fee they're going to charge. They tell you how much interest they're going to pay. They are in total control because of their role as an intermediary. That is what our centralized finance system does. The alternative was invented by Satoshi when Satoshi created Bitcoin, decentralized finance. And all it means is peer-to-peer. In other words, if I want to send Jeff money, I don't have to send it via the bank. There's nobody in between Jeff and me. There's nobody in between the buyer and the seller. In our centralized world, we have lawyers, bankers, brokers, insurance agents, title settlement companies, escrow agents, all of these intermediaries pushing paper to facilitate the transaction. In a DeFi world, none of them exist. It is only the two participants of the transaction. That allows the transaction to move without any friction, without any fees, without any time delays, without any government control or ability to interject. A lot of people find that pretty exciting. Others find it incredibly scary. It's a little of both.
So what incorrect assumptions have you made around digital assets since you got involved 10 plus years ago?
The biggest mistake I made, Jeff, well, two biggest mistakes. The first is not putting 100% of my net worth into Bitcoin in 2012.
Seriously? Wow. Well, I guess over the past 11 years, you could make that argument. Yes.
Exactly. I mean, my other big mistake was not buying Amazon and holding it forever. My other big mistake, that's the silly, dumb mistake we all have made by not buying what proved to be a great investment.
Right.
So that's kind of funny. But the real serious mistake that I made, or I should say not mistake, but failure to anticipate, it never occurred to me that crypto would become such a controversial, emotional conversation. People have incredibly strong opinions about this, often without knowing what they're talking about, favorable or unfavorable. I've seen crypto bros, as absurd as some of the crypto skeptics. I've seen astonishingly stupid comments by an amazingly large number of people, and all of them with a huge level of emotional conviction. It's just another asset class, and we're only talking about a 1% allocation. Why are we talking about it 50% of the time? Why is this generating so much emotion? I never anticipated this.
It's so funny you bring that up. I was kind of in preparation for our talk today. I was like going through the glossary in the training modules, and I saw Jamie Dimon in the glossary. And I can't remember exactly what you wrote, but it made me laugh.
You're talking about the certificate program,
yeah,
in blockchain and digital assets. Let me
here. I'll read what it says in the glossary. Jamie Dimon, a person who doesn't know anything about Bitcoin and who demonstrates that fact by making ridiculous comments about it.
And then it also says, see Warren Buffett.
See Warren Buffett.
So yeah, I mean, it drives me crazy when Jamie says, I don't know anything about Bitcoin, let me tell you what I think. I mean, and he said at one point he would fire anyone in his staff who engaged in Bitcoin, and yet his bank is one of the leading engagers in blockchain and Bitcoin or crypto settled transactions. So that kind of stuff just drives me crazy. That doesn't help the discourse. It doesn't help us answer the questions of what should we do with this technology? How do we make it work for us, not against us? You know where there's a similar dynamic? ChatGPT.
Yeah.
It's generating of late very similar levels of conversation. Some people saying it's the greatest thing in the world that will cure cancer, and others saying it's going to wipe out the human race. Can we have a more rational, measured, intelligent discourse and conversation? It just drives me crazy when otherwise intelligent people say unintelligent things.
Well, this area of conversation kind of brings us back to close to where we began. And, I did notice someone pointed out to me that the Financial Planning Association's investment trends survey really seems to point to a decreasing level of interest among advisors in participation in use of cryptocurrency, digital assets with their clientele. You made a pretty compelling case today, Rick. Let's maybe mention for our advisor listeners to a little bit more about the certification program that you've put together in case they want to really learn a little bit more about it. And for our consumer listeners, you may very well want to work with someone who has this kind of a certification if you decide you want to investigate this for your own portfolio.
Yeah, I appreciate you saying that. It's classic behavioral finance. With Bitcoin falling 77% last year, people love to buy high, sell low. So the mere fact an advisor says, I'm less interested in this right now, I'm getting fewer client questions right now, that's a buying signal.
Yeah.
You know, you're not supposed to want to talk about Bitcoin at 60,000. You should be thrilled to talk about it at 25,000. So the fact that you aren't interested is demonstration that you should be. And the best way to get started is through education. You know, we know that that's the best way to begin. And our certificate course is the best program in the marketplace by far. It's an online self-study, self-paced course. Jeff, have you finished the course at this point?
I have just so I think it was a couple of years ago that this came out.
Yes.
Through FPA, and
we started
I
at
think
the same time. He raced through it. I have like 2 more chapters to go.
And I was just going to say, you know, the average is 10 days to complete it. Some people binge it in a weekend. Others take months. So it's entirely up to you. It's a series of videos. There's a short quiz following each one. You get up to 18 CE credits. And this course is divided into 2 parts. The first half is all about the tech. What is blockchain? What is Bitcoin? How does it all work? The second half is all about practice management. What's the investment thesis? How do you construct a portfolio? What are the investment options? Regulation, taxation, compliance. And most importantly, how do I talk to my clients about this? One of the neat things that I think is an interesting byproduct of this conversation is that crypto represents a new and unique opportunity to differentiate yourself with your clients. Most advisors are not talking about crypto. Most of them don't know anything about crypto. If you talk to your clients about it, just begin by asking one question. Do you own Bitcoin? National surveys show that over 20% of US adults own Bitcoin. And that means a lot of your clients own it. And if I'm willing to bet that they don't understand custody issues, they don't understand tax issues, record keeping, you can provide tremendous value to your clients by helping them understand that you know about this. You know more about it than they do. That's how you create value add for the client. They will tell their friends who own Bitcoin that their advisor, you know, hey, my advisor is helping me with my tax issues on crypto. The other clients are going to say, my advisor never said a word. This is a way you can generate referrals, build your business. You can attract more AUM by simultaneously helping your client create and maintain wealth. This is just another asset class. It's not going anywhere. It's here to stay. It's growing daily. And you need to learn about it just like you need to learn about everything else in the field of personal finance.
I took an interest in it on the basis that I was, you know, as you can tell, I'm a little skeptical, not sure it's exactly right for my clientele, who are mostly retired folks. But that being said, I wanted to learn more about it. I've get, you know, questions come up and people want to ask about it. So I want to be more knowledgeable about it. I have found it to be very helpful as a way to get more understanding of what it is that we're dealing with. And I would encourage people to take a look at this as a way to better understand the subject.
You know, one of the most popular seminars and webinars I teach, I did this at the FPA conference in Seattle, is called How to Build Your Business by Hating Bitcoin. I don't care whether you like Bitcoin. I'm not recommending that you buy it. That's not my point. I simply want you to be educated. Once you're educated, you'll be able to make the decision that's right for you and your practice and your clients. It's kind of like annuities. We all have strong opinions about annuities. Right. I don't care if you like them or hate them. You understand them. You know the tax rules. You understand the difference between a beneficiary and an annuitant. You know how the thing is constructed. You understand the fees. That's got nothing to do with liking it. It's simply understanding it.
Welcome back to Something More with Chris Boyd. I'm Chris Boyd, certified financial planner practitioner, here with Jeff Perry, JD, who is a investment advisor representative with Asset Management Resources. And our show's a financial show, so we're talking about money issues today. And of course, we like to talk about something more too. But today, we've been talking a little bit about cryptocurrency and digital assets.
That was a very interesting first hour, Chris. Very interesting.
I enjoyed having Rick Edelman as a guest. He was very generous with his time.
He was.
And a great guest to have. He's got a lot of energy, a lot of passion. You know, he certainly is an individual who has a wealth of experience in our industry.
Right.
And has had, you know, reached the pinnacle of success in terms of he's worked with clients without minimums and created the largest RIA at the time of his leadership. I don't know if it's still the case. I know he used to mention it on his show that when that was the case, I assume it's still, if not the largest, among the largest, nationally renowned. And so in any case, it's great to have him as a guest. And
Not a guy I always agree with, though. I mean, he's very
no,
successful.
I think that's why we want to talk about this a little bit more.
Not diminishing his success. If people Google him, they'll see his fame and success. It's there. It's real. I respect him for what he's achieved, but he's a little edgy on some things. And this cryptocurrency issue is one of the ones that I don't think I agree with him on.
Yeah, I guess you call him an early adopter. The question is, I think, for us to think about with our clientele, there are a lot of things that within that content we didn't get to ask him. For example, I think I did it early on with a flurry of questions, but we never got to get back to, we're trying to cover so much in a short period of time. Like we never got into tokens, non-fungible tokens or fungible tokens, any of that stuff.
Right.
But we didn't really get to ask him about valuation. That's one of the sustained critiques I hear from people in investments.
Right.
I understand, how do I evaluate the productivity of a company and its relative, to assess its relative valuation from the point of view of, I can see what it's earning.
Yeah. Revenues, profits, dividends, growth, and all those.
Et cetera.
Yeah. Like a financial analysis of a company is easy to think about.
Right. That kind of thing. But how do I go about valuing cryptocurrency? Oddity, in a sense, where it's what people perceive it to be. And
supply and demand at this point, right?
Yeah, in some respects. And unlike those kinds of assets, many of those have, as you were talking before, they have some practical use. You can put silver into technology. You can, gold is used in jewelry or whatever it might be. But it's challenging here to say, Bitcoin's going to have increasing value because there's a limited number of coins that it's going to be created. But who's to say that I can't then just use Ethereum or
the next coin,
something else?
I think you asked a lot of great questions, and I appreciate the way that you interviewed him, in that you didn't throw him softballs because, of his position and his success. You were asking him pointed questions, and I think But
I also wasn't really coming back at him I wasn't challenging him on things. I was like, gave him some tough questions.
I don't know. You followed up with a very intelligent and thoughtful question when you were talking about early adopting of assets, technology, when you asked them about, back in the 90s, I don't know how you phrased it, but you would have put all your money in AOL and Prodigy and some of these other companies that were the industry leaders. In fact, many of them didn't have competition. And now where are they today? Right. So, and if you kind of just said, this is the future, I'm going to hold on to this for 30 years and retire, because I put all my money in one thing. He even suggested that was his best.
His mistake, huh? Yeah.
I get what he was saying, though. I don't want to miss.
Yeah, I follow it. He was saying, look at how well I would have done, even with volatility. I just think the volatility is a big issue for people that they need to think about. I also want to, in the case of, he made the analogy to to Amazon, right? And when Amazon started, I don't know if you remember, but I do. There was a lot of critique about, it was a shell game. They just didn't have any earnings for the longest time.
For a long time.
They didn't have any profitability. And what they did was they just plowed all their money back into infrastructure, developing more and so on. But for a long time, that was a very speculative bet. And it's true in hindsight, boy, you'd be so rich. But this is why we diversify. This is why we don't have all our money in one thing, because there's a ton of risk sometimes when you get very speculative in a startup company. In this case, a startup technology, maybe. Yeah, I don't know.
Well, there were likely 1,000 other startup companies that at that time doing similar or different things, retail companies or technology companies, or however you want to characterize them, that are gone today. So it's easy to pick. It's easy to go back and say, well, see if you picked Amazon, where
It was
you would
obvious.
be.
Yeah.
Right. It was obvious. Yeah. Well, it's obvious today.
Yeah.
Right.
Well, and I mean, I'm not trying to put words in his mouth. I was making that point that, in hindsight, you'd say, oh, this would have been a good thing to do. That may be the case. I think for most investors, though, the issue is it's extraordinarily volatile, and there's a risk of a loss of principal, potentially a high risk of a loss of principal. And so, I think it's important for investors to treat this as in that vein. This is a highly speculative, potentially, a risk of loss of principal. And if you're tolerant of that, and that's why, when he said 1%, that resonates, because you think, okay, well, I can maybe afford 1% a loss, but is it appropriate for everybody? I think that's questionable. You know what I mean? And how you do it. I did think he made some interesting points that there's more than one way to go about it. You don't necessarily have to own Bitcoin or Ethereum or some of the others as a way to accomplish this. You can own related industries that are transacted as securities, and things that might be adjacent to the blockchain development.
Well, a lot of them do trade kind of in unison, though, with Bitcoin. We'll just use the term Bitcoin because that's what.
Generally. Yeah.
So it's not right for me. It's not right for most of my clients, or all of my clients. I haven't had a client who wanted, after learning or not learning what it is, I haven't had a client who had a strong interest in it. So
I have, Jeff. I've had clients say, I'm just going to buy a little bit with a what do you call it? A sandbox account,
right.
Where generally I've been like, oh, I'm not sure it's a good idea. I wouldn't really recommend it. And here, that kind of thing. And, suggested maybe that if they do it in very small measure. And, of course, most of the times it's been this situation where it leads to significant losses, or has thus far, for these people because they're late adopters at this point. I don't know if we're, that it's been over the last 2-3 years that this has been more prominent. And of course we've had more, significant downturn over the last year or so. That being said, I had a call this week from a client. I'm not sure, 80 something, I think, looking to say, well, I think I might do a little bit. Someone in the family was recommending it. Here's very
that's always a winning advice then.
Yeah, exactly. But
when Uncle Joe
they asked me to look into the amount, and they're saying, what about this amount? And I was like, ooh, that might be too much. Let's look at something that's, less consequential. But in any case, it's appealing to the idea of get rich quick. We all love the idea of like playing the lottery on occasion. That's what this is in some respects. So the interest of, can I suddenly have these explosive returns?
Well, look at the increase in sports betting. I mean, so people like to take risks on things that they know a little bit about.
Yeah.
Right? And they like to root for something and, try to make big gains overnight. But I just go back to, Peter Lynch, Warren Buffett, Bogle, the real pillars of success in investing. And it's invest in what you know. Slow and steady is the way to wealth. Be disciplined, take measured risks, understand what you're doing. Certainly the past is not a promise of the future when you're investing in stocks and bonds, but at least there's a history there. There's a way to evaluate it. There's a way to measure. There's a way to put a value on something you're investing in. And there's something behind it. Sure, companies go bankrupt. It's possible to lose money. And it's certainly people lose money in the stock market every day through a company that went bankrupt to just from a down market. But at least there's a process, there's a way. There's fraud issues. There's fraud issues with the cryptocurrency. I know you didn't have time to go into everything, but I would have enjoyed hearing what he would have to say about the elements of criminals and cryptocurrency and that.
Yeah, I think he's I've heard him comment on that in the past. We didn't get to talk about that, but the idea that there are bad actors that use dollars and there are bad actors that use stocks. There are bad actors in any space, that kind of thing. That blockchain is and digital assets are no different, that kind of thing.
Yeah.
But I know what you mean, that there's a concern that doesn't it seem to attract this idea of people doing things outside the banking system seems to attract people who are doing somewhat illicit activities.
Well, he commented that was one of the primary or most useful things for this technology is transferring money overseas.
Yeah.
Money that could be involved and sometimes is in the criminal enterprises, or money that's being, is evading taxes. And I don't know. I think the SEC is on point with what they're doing. I know that you had some conversation on that, but I think they are starting to regulate it, and as a security. And
yeah, I think
good.
and they're
good.
treating it for taxation as that's same
right.
function. It's a capital gain. I think it's hard to pin down what is it. Is it a security? I mean, certainly not. As we said, it doesn't have some of the characteristics of other securities. But I think it's in the consumer's interest that regulators start to catch up. One of the people I asked for suggestions, and I did ask several people, so you among them and other advisors that are peers in the industry, what would you ask if you had the chance? And one of our peers indicated the idea that this notion that it's a worry, when it comes to bad actors.
I can make an argument that the regulation that is here and coming more, certainly over this technology, over this asset, whatever we want to call it, is good and bad for the price. Meaning, if it has more regulation and people gain more confidence that at least it's following some rules, maybe people will be more willing to put their toe in and consider it as an investment. I can also suggest that if they regulate it and follow it and push some of the bad actors out, that those individuals will find out how much, what percentage of this use of cryptocurrency and exchanges, et cetera, are being done for nefarious reasons that could push down demand for people. So it's an interesting dynamic there that regulation can be viewed positively and negatively, I think, for ultimate price appreciation.
I think as the price rebounds, which I think inevitably it will continue to, go back and forth, but and likely rise over time. I do think, the issue that we talked about at the end of the conversation, that advisors are less enamored of it today than they were a year ago.
Right.
I think his point was well taken, that that's probably simply in part because it's gone down and it's
that's behavioral.
But I do think that, it does, again, it comes back to, but is it appropriate for most clients? When it comes to our clientele, we work primarily with retirees.
Right.
Or if not people in retirement, people pretty darn close to retirement. They have a different perspective about how much they're willing to endure decline and how long their outlook for recovery might be. If I'm, in my 30s or younger, or, maybe 40s and even 50s, I might be more tolerant of a portion of my wealth, being depressed in price dramatically for a length of time. But as I get closer to retirement, we tend to be less so. So, and the mindset of, well, how long do I have to recover? In reality, people live in retirement for quite a long time, but we tend to be less tolerant of it, I guess. And so, makes me think about that as a concern for our clientele. And, again, it's something I would be cautious about, as if it becomes more pragmatic in the sense of how we can access the transaction. Like right now, it's a pretty big undertaking to have digital wallets and all this other stuff that becomes challenging to say how do we incorporate this in the way we do our portfolio management. He talked about the idea that maybe it'll be more accessible as we go forward. That may be a way that it becomes more mainstream and more
it may be, or
palatable for people to use some of it.
it may be, or is there a new technology that we haven't contemplated yet?
Yeah.
Displaces think about how fast the AI in general, but how fast AI, it's been around for years in different formats, but how sudden AI has impacted virtually every major corporation in the world in the last few months. And is there something else coming that we don't know that could overshadow or reduce or eliminate the perceived benefits of cryptocurrency?
Yeah,
that's the real risk
question.
To me, right? Because look what happens to industries. I mean, think about if you owned a travel agency, in the 1980s, 70s and 80s, and it's a very successful business, and then bam, right? The internet comes along and your business evaporates. So
yeah, to a large extent.
That's one of the risks, I think, with cryptocurrency and such, that something next could be coming, that all the reasons that you have cryptocurrency could just disappear with something else that's on the horizon.
I also have some reservations about the whole consequence of decentralized finance that people celebrate, I think, who are fans of the approach, and I understand the appeal, but in times of crisis, there is virtue to having a central bank and that whole approach that I think people sometimes discount and don't appreciate, having lived in an era when we haven't had panics the way which were more common prior to the establishment of the central bank.
I agree. That part of the interview, when he was talking about decentralization and the banks, was probably the least credible part of the interview to me. I found, I didn't agree with his comments at all regarding that. I share your views on the need.
It's funny. I think ideologically our shared mindset is that generally it's good to get government out of things, that we want
absolutely
limited government. But this, I think, and particularly in our lifetimes, we've seen the consequence, the benefit, the virtue of having a central bank that pulled us back from the brink in 2008. And, some of those, just more recently, we've, seen what could have been a ripple effect with a run on banks, that by making some adjustments with the availability of how bonds are going to be considered on banks' books by the Fed and FDIC addressing some issues. I think he still has a point. We really still have an unresolved issue when it comes to payroll and corporate balances that are in banks. We really have to figure out a solution there. That, clearly the FDIC can't have unlimited funds that are insured, but we do need to have some kind of a game plan around people. Big companies have a lot of money in
small number of places,
right? A small number of places that just practically you can't have. How many banks can you have? That to deal with your payroll accounts. You know what I mean? So it does raise some interesting and challenging issues as it relates to those kinds of issues. But in any case,
well, off on your political comments, I think it's important because we share the and many of our listeners share the view that limited government is the best type of government. But let's be reminded that when we founded our nation, the
There
reason
still
that we
was a
had
role for government. You know, there
Well,
still
yeah.
was government. You know,
the reason we have a constitution is because the Articles of Confederation were not working. It didn't give the central power, the central government, enough power to have a defense, to have regulation of interstate commerce, to ultimately have a banking system. So the founding fathers got together and had another convention, if you will, a constitutional convention, which was designed initially to work out the shortfalls of the Articles of Confederation, but ultimately led to a new constitution to give the central government, the federal government, a little bit more power to deal with these things that they understood, like interstate commerce, like
Yeah.
banking, so that we could have a functioning country. So limited government, absolutely. But for those folks who think that government has no role in banking and the flow of money, we've been there before in history, and it's not the answer.
Yeah, thanks. I'm glad you went back to that because I think I veered off on that comment, and I do think it's important.
You're listening to Something More with Chris Boyd, Financial Talk Show.
Asset Management Resources, LLC, and J. Christopher Boyd, CFP, provide investment advice on an individual basis to clients only. Proper advice depends on a complete analysis of all facts and circumstances. The information given on this program is in the nature of general financial comments and cannot be relied upon as pertaining to your specific situation. AMR, LLC cannot guarantee that using the information from this show will generate profits or ensure freedom from loss. Listeners should consult their own financial advisors or conduct their own due diligence before making any financial decisions.